Hey folks, in this video we're going to talk about retail disasters, and this stands in contrast to, for example, the Macys stock price action or earnings report this morning, which we're also going to talk about in this video. But there is a big red flag hanging out there, and I really want to drill this point home. Some of these things you've heard me say before, but the thing that I'm going to show you, a couple things I'm going to show you, you probably have not seen yet. So we're going to merge this all together, and we're going to talk about these potentially very dangerous stocks and how maybe to play some of these. So first, let's talk a little bit about Macys. So Macys is today being treated as the inflation god. The reason they're up 12% and they're being considered the retail god is in an era where Snapchat drops 40%, Best Buy plummets, and you get this essential Target plummeted 30%, Walmart plummets 20-30%, and all of these retail stocks are completely plummeting because retail stocks that were thought to be safe during an inflation environment, you actually have Macys here killing it. Macys, their margin is up about 5 basis points. We're up to 39.6 versus 39.1. Their net sales blew expectations out of the water. Expectations were about 250 mil, 249.3, came in at 315, up 12.4% in Q1, the same quarter that we've now heard about a potential negative GDP print that actually got worse, not better, okay, despite prior revisions to other reports we've seen. And Macys is actually suggesting that their fiscal year guide, is going to be 10% greater. But when we dig a little bit deeper, there are some really important things to notice here. And this is what I kind of call the retail disaster. And I want to show you a few charts, and then I want to show you what companies like even Macys are saying. And I think it really helps paint a clear picture of what we've got going on. So the first thing I'm going to show you is something that we've actually talked about in the past before, and it's sort of this is just a little bit of a recap, and I just want to make it very, very clear in terms of where sort of my head is going into this, and then we're going to compare. So my head going into this sort of inflationary environment has regularly been that if on the left side over here you draw household incomes, 50K, 80K, 100K, 150K, 250K. And then on the right, you kind of draw just various different companies. So, for example, here we put Nike. I'm going to keep this a little short because I have explained this before. But when you look at this, it's like, okay, well, who buys a Tesla? Well, a person who buys a Tesla on average has around $150,000 per year household income. So you're probably talking about your wealthy individuals down to maybe about 100K, right? Who buys Apple products? Well, probably people not making 50K, but somewhere between, say, like 90 to 130,000, and then potentially up from there, right? Who buys Nike? Well, this is your lower kind of demo and up. Wealthier people buy Nike as well, so this could probably extend. The point is, when you go into an inflationary recession, what you're kind of doing, in my opinion, I want to show this visually here, is you're kind of taking like a saw blade and you're going like this. You're starting at the bottom, the poorest people, the people who spend like 50% of their income on food and 30% or 40% of their income on shelter, like food, gas, and shelter, and like all their income's gone. They're totally paycheck to paycheck, making $20,000, $30,000. You take a saw blade to this area and you're like, yep, you ain't buying new Nike shoes anymore. And then that levels up and it's like, no, you ain't buying Apple phones anymore. You ain't going shopping at Target and Walmart as much as you used to because inflation's sawing that away, right? And so obviously it takes longer for that kind of pain to get to more luxury good companies. And so what's fascinating is if we actually look at this chart, which just came out from Morgan Stanley, take a look at this. The bottom quintile has less excess cash than they did in 2019. This is really interesting because let me first give you this. Overall, so all consumers together have about 140% more PP than they did in 2019. PP being purchasing power. We also believe that on average, households have roughly $15,000 more cash than they did before the pandemic. But this is an average. It encompasses everyone. And it's really not until you zoom out here that you realize, oh crap, it's actually the lower income demos that are getting reamed here. Look at this. the people making 0 to 20, or the bottom 20% making, very little money, have no excess cash. They're at $0 of excess cash. The people in the bottom 20 to 40% have $3,300 of excess cash. The next 20%, $9,200. But look at the top 20%, how much excess cash the top 20% has. They have $56,000 extra. Like, you could buy a lot of iPads, right? So one of the things that you can do is you can Google something called, what income percentile am I in? And you could throw in what your income is and calculate what percentage you're in. So, for example, if you make $63,000, you're about in the top 58%. If you want to be in the top 20%, I'm going to take a guess here. I'm going to go with 140,000. Yeah, you're at the top 12% then. If you make over $100,000 a year, you're about in the top 20%. So the people who make over $100,000 a year have an excess of about $57,000 on average. The people who make virtually, or the bottom 80%, which is like a lot of people, the entire bottom 80%, substantially less money than these wealthier folks. And so what does that mean for what people are buying? Well, listen to this. And this becomes important, like if you're picking stocks. Macys tells us something that we have seen reiterated by JP Morgan, Visa, and almost all of the other retailers, including Target and Walmart. Target, Walmart, they talked about how we're seeing, and so did Lowe's and Home Depot. They all talked about this. We're seeing a shift away from landscaping. We're seeing a shift away from furniture, but people are still buying luxury products. They're just buying a lot less of other things like apparel or sort of general merchandise. Luxury products are still selling. All the other stuff, that bottom saw blade of stuff, not doing as well. What did Macys tell us this morning? Quote, a noticeable shift to occasion-based apparel. What that means is that bottom threshold is like, crap, I can only buy clothing when I need to. Like, oh, I need to get a tuxedo, I need to get a dress or whatever for an event, but that's it. I ain't buying clothing anymore because I can't. Either I already have or I have no money left. They're also seeing a noticeable shift back to in-store. That's kind of interesting because I think after the pandemic, everybody's like, oh, retail's dead. Like, there's no way retail's ever coming back. Everything's just gonna be online. Apparently not. People are still wanting to shop in person. But here you go. Quote, continued strength in luxury goods. And I thought that was fascinating because this is the same kind of stuff we saw from Dick's Sporting Goods. It's the same thing that we saw from Nordstrom's, Ralph Lauren, and a lot of these other companies that I mentioned already, Visa, JP Morgan, whatever. That's the bottom incomes of threshold of spending. Those are the ones that are getting whacked. We kind of already knew that. But let me now show you mobility data that shows potentially going forward, because this is like information that's probably like 30 days old. You know, these investor calls, they kind of get prepped beforehand. They don't necessarily have to give us all of the latest info, though it's some of the most recent stuff that we can get, especially on the earnings calls. So I still really appreciate looking at the earnings calls, but I also realize they're a sales pitch. This, though, was dirty, okay? This chart that I'm about to show you. This, in my opinion, somewhat scary. So there's this thing called mobility data. And that's that when you use your cell phone, you're like a dot on a map. And your dot kind of flows throughout the world. The NSA and CAA and FBI or whatever, they can follow your dot, which doesn't have your name on it, but they can assume it's you based on where you live and where you work, and then they can pretty much track you wherever you are. So if you think you have privacy, you really don't. Now, what's interesting, though, about this mobility data is it gives us a lot of insight into where people are going for the purposes of stocks and investing. And so I like that because even though it kind of makes you wonder about privacy, it's also really cool because maybe it gives us a little bit of a forewarning what's to come for future earnings reports. So this chart here is broken down by company, and I'm also going to give you some overall sectors. Sector declines. I'm going to start with the sector declines, and then I'm going to show you the chart. So this number just came out this morning. Overall retail traffic fell 9.7% in this last week compared to the same week last year. That's bad because everything so far has been beating last year. Now we've got a big plummet here in retail traffic. but you'll be surprised at how much some of these stores and sectors are down. I just have to give you a quick reminder. If you want a bundle code for the programs on Building Your Wealth, use that coupon code, link down below. There are a bunch of bundles listed, and if you want to email me for a special bundle code, like if you're confused, like which bundle to get or whatever, just send an email to kevin@meetkevin.com. You got to give me about like a 48-hour response time. We're a little bit backed up with so many people emailing and asking, like getting set up and getting started and stuff like that. But we can take care of you there. And check out all of the different things that you have, and know that there's constantly new content that gets added. We've got a really big batch of new content coming out in the next couple weeks after that largest price increase at the end of the month. And then we've got a new content dump coming. So really, really excited. Check those out. I think you'll really enjoy them. So retail numbers here. The biggest hit by categories, a negative 24.6% decline to home improvement and furniture. That does not surprise me at all, because people stop spending on their homes when they're worried that real estate prices are going to start ticking down, or when potentially they're fearful that that appreciation has stopped and home appreciation is no longer going to finance their opportunity to just spend money like crazy on their homes. Also possible that, you know, people have already bought furniture with their second homes and all this kind of crap for those fancy people, but whatever. Biggest hit, 24.6% decline there. Department stores and apparel, this actually includes Macys in aggregate, down 13.8% on retail traffic data. And now I'm going to show you store by store, and it's kind of crazy. Who remembers what I talked about a few days ago when I talked about a certain company where the CEO's like, oh, we are noticing a big slowdown in consumer electronics, like, not sure if we're going to see a recession, but maybe it'll be like a softest recession. Well, that CEO was the CEO of Best Buy. And take a look at their retail trading data right here, folks. Look at this chart. This is scary. Best Buy, folks. Best Buy. Year over year retail traffic down 56%. And change on the week down 4.9%. Bed Bath & Beyond year over year down 36%. Ulta Beauty down 31%. Lowe's and Home Depot down 30%. Target 27%. Kohl's 25%. Victoria's Secret 24%. Gap 19%. Macy's just killed it on earnings. But yet, week over week, they're down 5.5%, and year over year, their retail traffic is down 19.1%. Folks, this is a sign that people, especially that lower demo, are getting killed by inflation. And it's starting to show up in how often people go to stores in the first place. People are even going to Publix 17% less than they did last year, and 6.8% less week over week. Now, I don't recall of any kind of like crazy hurricane or anything that all of a sudden made people stay home, but these are some bad numbers. Like, I think the only thing that went up was the beauty sector year over year. Oh, categorically, beauty went up 0.6% year over year. Dollar General, folks, the dollar store, up 2.7% year over year, but still down 7.2% on the week over week. Grocery stores are seeing less. Aldi is fractionally up on the week over here, but all of these numbers are terrible. Like, I don't want to invest in those numbers, and it also kind of makes me wonder, like, is Dave & Buster's in that kind of similar category here? It's kind of scary. So it's something to keep an eye on, that retail does get crushed by inflation, we know that, but specifically that lower demo. And this consistently makes me wonder, like, are the companies that I want to be in, are they the Teslas, the Apples, the Starbucks? What appeals to that higher demo where they're still going to spend? So even though Macys is doing really well today, that chart was not very exciting to me. But there's also this belief that potentially the end is near, that inflation will end up being transitory. Now, I don't want to sound like a broken record, because I know when people hear that, they just roll their eyes, and that's fine. But take a look at this. Diesel prices, although they're at roughly an all-time high, they're starting to peak, and inventories are starting to climb. We know that when inventories go up, prices tend to eventually come down. Diesel prices have finally hit that level. No guarantees they won't go higher, but it's a good sign. Lumber prices are at the lowest level they've been in since October. It's been straight down for lumber prices over the last 4 months. You have a smoothing / easing of freight. Fertilizer. Who remembers how fertilizer was essentially just going to go to the moon because of Ukraine and Russia, where we have substantial amounts of fertilizer exports, somewhere between 40 to 50% of the world's fertilizer. Potash comes from this region. Well, even though it's true, those prices have come up substantially, fertilizer prices are down 20% from their peak. You can look it up. Green Markets North American Fertilizer Price Index. Clearly, we know that there are going to be over this next decade, we're going to look back at this era and go, holy crap, that was a lot of inflation. The question is just, how long does it last? Market expectations are that inflation is going to come down, and we're starting to see that. You look at the used vehicle index, it's going to probably be a drag on CPI numbers coming out next month, and it's a good thing. It doesn't eliminate the fact that lower-end retail is still going to get absolutely destroyed by the higher prices that we have now, but not just by the higher prices that we have now, but also by the fact that people have less money. We saw that when we looked at the chart of who has the extra cash, who has the extra wealth. This chart right here, it's certainly not the lower-income demographics. So I think we'll see that pain coming in the Lululemons and the Nikes and so on going forward, but haven't really seen that yet because we've been so focused on prior quarters where people still had money. Now the good news is companies are raising wages, and that can eventually help that lower income demo, but it takes a while for you to actually get in your job, for you to start saving money, for you to get out of sort of the debts and how far behind you are, and then actually spending money again and feeling comfortable again. For example, Apple just announced that they're going to increase pay for its workers to $22 an hour. That is up more than 45% from 2018 wages, according to the Wall Street Journal. That's pretty wild. This is also happening at the same time as Apple is actively discouraging their employees from unionizing, suggesting that their employees might have less flexibility, less opportunities to work from home, and less opportunities for promotions if they unionize. Now, this is sort of like unspoken and duh, but recently in the media, it's been coming out that Apple, like these things are getting leaked in the media, and people are kind of pissed at Apple over this idea because it paints this picture of the big corporation versus the employee. And so Apple's trying to take this proactive step of raising wages again. And you see this sort of increase in compensation, whether it's through stock-based compensation or hourly wages, frequently now, including at companies like Amazon and Facebook, although both those companies, those latter two, have frozen hiring because they'd rather pay their existing employees more. This is also, by the way, when we noticed that Apple, and we're not sure if this is directly related to this sort of retail destruction, but look, Apple is not an extremely luxury brand. It's a more expensive brand, right? If the average household income in America is $60,000, Apple probably appeals to that $80,000 to $90,000 average income demographic. So Android users are statistically lower income than Apple users. We know that. Those are facts. But Apple now asking suppliers to make about 220 million iPhones this year, which is flat from last year, is also a little bit of a sign that maybe you're starting to see that shaving away from retail purchasing interest. Now, Apple was expected to produce about 240 million iPhones this year. And so a little bit of bad news there for Apple because that came in substantially below expectations and flat, and reiterates concerns over what's going on in China with the strict lockdowns, softer consumer spending, and of course the inflationary concerns. So all in all, this is the kind of market to just be careful with which stocks you pick, because I think a lot of bad news for the lower end retail is actually ahead of us, not behind us. Again, Nike, Lulu, Macys, these guys have all been killing it with their earnings. I'm just worried if this is the kind of mobility data changes that we're seeing, coupled with who has the excess cash, who doesn't, who's going to the store and who's not, who's spending and who's not, who has the capacity to spend and who's not. The retail, a lot of these are just companies I just cannot get into. And that's why I've really been trying to focus on, I'm just going to try to, as much as possible, park money in the high income demos or the more luxury goods. Okay, good. That gives us an update on retail. Make sure to check out the programs on building your wealth down below. Look forward to seeing you there. Let's go back to the sticks.